In the next several videos, I want to explore long and short-term financial planning. So we're going to look at the distinction between these two things because there is a difference in what we're trying to review and analyze in this planning process. So the financial planning process, again, it can either be long-term and strategic, or it can be very short-term and more operational. So long-term plans are typically 2 to 10 years. They look at a company's financial actions and impact of those. So the long-term financial plans is really all about strategy and financing. Where do we get money? What things do we buy? Where do we get the money to buy them? So on the short-term side, we're really looking at an operational piece, right? How does the company manage its cash flows over the short term? Maybe this is broken down into a month, right? Some very small companies might do this on a weekly basis, right? Certainly it's less than 1 year. So this planning is done in very short time frame segments. Again, long-term finance planning is all about finding out plant and equipment, looking for research and development, marketing, capital structure, finding sources of financing, right? These plans are generally supported by annual budgets and profit plans. Now, sometimes this long-term financial planning is referred to as profit planning. I really don't think that that's the end goal. The end goal here is not to plan for profits. The end goal is to review our expectations of operations and try to develop a plan to finance those operations. And that's what we'll talk about when we get to these long-term plans. The short-term plans, again, are very short, right? We're looking at maybe a quarter, like 3 months at a time. The data we get comes from sales forecasts, operational data, right? We're going to develop some things moving forward, right? We're going to develop operating budgets, cash budgets. This fits into what we ultimately refer to as the pro forma financial statements. So the development of these plans is critical to the ongoing success of the company. So let's look at, again, how do we analyze cash flows, right? So cash flow is the primary ingredient in any financial valuation model. From an accounting perspective, cash flow is summarized through the statement of cash flows. From a financial perspective, we need to what are we going to focus on, right? Not total cash flows. We want to look at what's referred to as operating cash flow. Management is interested in this. This is the amount of cash that's created through running the company itself. Now, free cash flow, we're going to watch this very closely. We'll define this a little bit more detail later. This is a number that's definitely watched by the financial capital markets, right? Investors are very interested in this free cash flow item. So let's first talk about the challenges with cash flow. What makes profit and cash flow different? There are a series of items that fit into this challenge, right? This change that happens. The one that's most prevalent is called depreciation. So this is the proportion of costs that are charged against revenues over time. If a company buys a piece of equipment or builds a building, let's say they spend $100 million on a building, they don't expense that the year that they buy that. The reason is there is an accounting principle that's called matching, where you need to match the benefits of that building to the cost of the building. Well, the benefits don't happen until the future. So depreciation is just a way of taking the cost of buying an asset and segmenting it or dividing it in a systematic way over time so we can make comparisons to the revenues that it generates. From a tax perspective, we use something called MACRS, Modified Accelerated Cost Recovery System. For financial reporting purposes, though, we typically use other methods. Frequently, it's something referred to as the straight line depreciation. So let's talk about MACRS just for a second. Obviously, it was created many years ago. I think this was 1980 is when MACRS was developed. There have been obviously many changes to the tax system. Recently, as of 2017, there's been a change. So we depreciate most items, most assets are depreciated using MACRS. However, over the last several years, up through 2021, we were able to deduct 100% of the cost of most items from our plant and from our income. Now, moving forward, 2022, for the next several years, we're going to be able to deduct percentages, much bigger percentages, but the remainder, right, whatever we don't deduct, we are able to deduct using MACRS. And again, this is a little bit beyond the course. We just have to remember that how we calculate depreciation and how taxes in general are applied, they change. So we have to be flexible and understand the general processes for doing this. So the depreciable value of an asset under MACRS, it's the full cost, including any outlays for installation. So for instance, if you have to ship the asset across the country, the freight cost is part of installation. It's part of the full cost of the asset. So that's included. So here we have a company, they got a new machine that costs $38,000. Installation costs are $2,000. Now, when that machine is retired from service, they expect to be able to sell it for scrap for $1,000. So what is the depreciable value? Well, in MACRS, we don't care about the salvage value. We only care about the full cost, including outlays. So in this case, the depreciable value is $40,000, $38,000 in cost, plus the $2,000 in installation costs. Now, how do we know what the percentages are? How do we know what MACRS is and how do we apply that? The IRS provides us with some guidance here, right? The IRS determines the time period over which the asset can be depreciated. Now, keep in mind that currently there's some adjustments to this depreciable value, but after that, we still apply the percentages. So here's how this works. The IRS provides us with a table that talks about the property class or the recovery period. So 5-year assets are things like computers, light-duty trucks, cars, right? Turns out real estate is 27 and a half years. So once we can identify which recovery period the asset falls into, we then look at their other table, which tells us the percentages. So again, for this particular asset, for a 3-year asset, the very first year of the depreciable value that's left, again, assuming an adjustment currently, 33% is the expense, or is the depreciation expense. The next year it'll be 45, then 15, and then 7. So the calculation of depreciation expense for an asset is pretty simple. Find the asset class, find the table for that class, and this is how you depreciate it over its depreciable life. Now, a way that we can do this a little simpler, right, is maybe to use a spreadsheet, right? So if you create a spreadsheet where you identify the depreciable periods, right, the depreciable lives, enter the percentages, you can then say, look, the initial cost, in this case, I just said 40,000, right? It has a MACRS life of 5 years. Tax rate's 40%. We don't really need to know that right now, but we can then create a table. Say, well, if it's a 3-year asset, it'll calculate its depreciation here. This is a 5-year asset. So what is it? 33% of $40,000 is $8,000. So this is the depreciable schedule that we have for this particular asset. So that's the video so far for cash planning, right? Short-term, long-term financial planning. Look forward to seeing you in the next video.